Alright, so let's get straight to it. If you want to retire before everyone else and actually stay retired, then there are just three simple steps you need to master. Number one, calculate your real retirement number. You'll be surprised how few people actually know what that number is. Next, learn to manage the variables, and there aren't many, just 4 or 5 of them. And finally, execute your plan successfully. That's it. It's that simple. But you know what? Most people, and when I say most, I mean 60-70% of the people I know, they don't even make it past step number one. For some, it's purely a lack of awareness, which is understandable. Our school system doesn't do a good job when it comes to financial education. For others, it's this mindset that I'm not ready to retire, which usually means they don't truly understand the difference between retirement and financial freedom. That's fine. Everyone's entitled to their perspective. I'm not going to judge anyone. But if you're still here, do stick around for a few more minutes as I take you through a simple yet effective blueprint that will help you retire a lot faster than your friends and colleagues. And even if you don't want to retire, if you're someone like me who wants to take things a bit easy and relaxed, then I'll say this video is even more relevant as it will give you a numerical estimation on how much you want to exert yourself in the pursuit of financial glory. I've done the math for myself. I'm quite satisfied with the results. And let's begin. How much money do I need to retire? It's one of the most searched questions online, and contrary to what one might think, it's a question with too many answers. Of course, you'll need to customize it a bit to suit your requirements, but as a thumb rule, the most popular one is the 30x rule, or as some others put it, the 300x rule. What's the difference? So 30x is 30 times of your annual expenses, your current annual expenses, while the 300x rule is 300 times of your current monthly expenses. So one is annual, one is monthly, but mota, what the literature says is that if you have around 300 times of your current monthly expenses, then you are good to retire. For example, let's say you're 35 years of age and your stable monthly expenses are 70,000 rupees a month, which means in this case, if you have between 2.1 to say 2.5 crores, you can actually think of retiring. Sounds good? Naina? I mean, I'm not refuting the principle. I just think it requires a little more work, some more verification on our part, which is where I'd like to use a retirement calculator. So this one's by NISM. It's pretty simple in terms of the inputs, which is exactly how I like it. Okay, let's try this for a 35-year-old. So present age is 35. Let's keep the retirement age also at 35. Life expectancy, okay, 85. Long-term inflation is 7%. Present monthly expenses is, I think we said 70,000 a month. Reduction in expenses after retirement, no. Expected return pre and post retirement is 10%. 10% is realistic. Current savings is zero, kuch nahi bachaya, and retirement benefits is also zero. Okay, so that gives us a corpus requirement of 2.25 crores, which was a pleasant surprise to me as it beautifully aligns with the 300x rule. I even backtested this on a standard Excel. The numbers were somewhat close to what the NISM calculator gave out, so that's good as well. And in what's becoming a habit, I also tried AI with this prompt giving me a bunch of methods and answers. 2.47 crores per the inflation adjusted expenses method, 2.24 crores using PV, the present value approach, while the real rate annuity method pegged my retirement requirement to 2.25 crores. So most of our answers are around the 2.25 crore mark. And just to be safe, let's settle for 3 crores, which is what this 35-year-old spending around 70,000 rupees a month needs to have today to retire immediately, assuming his investments can fetch him 10% post-tax returns and a long-term inflation of 7%. If you aren't this person, of course you're not. And if you have no idea how much money you need to retire today or 5, 10 years in the future, then please do this exercise customizing it to your own situation. For instance, you might not be 35, you might be 40 today. Your expenses might be a lot higher, let's say 2 lakhs a month. You might want to retire 5 years from now, and because you've worked for many years, let's say you've managed a corpus of some 3 odd crores. So this one is a case of future retirement and gives this person a very good idea of where he or she is, where one needs to be, which is 7.5 crores of corpus by the age of 50. And it also gives us a plan of action in the form of monthly investments that are needed to be made for the next 5 years to the tune of 3.3 lakhs a month. So do try it. The tool is absolutely free, and while for some, the results might come as a harsh reality check, for others, and hopefully for you, this exercise will offer comfort knowing that you have enough in the bank to retire earlier than what you originally expected. Whichever side of the equation you're on, something I always suggest to all my friends, family, even viewers is to have one's insurance in place. I mean, we just talked about inflation rate. We use 7%, right? Now, the worrying reality in a country like ours is that medical inflation isn't 7%. It's significantly higher, around 13-14%. And God forbid, if a medical emergency were to strike you or your family, even the best laid financial plans can be thrown completely off course. Which brings me to the solution: health insurance. And an insurance aggregation platform I'm absolutely a fan of is Ditto. It's the service I use for receiving the best advice on insurance, to better understand what's within the policy, the wordings, benefits, exclusions. It's the one place I trust to get the right answers to all my questions. And as I've always said, Ditto is the nicest place to buy health insurance from. Why is it nice? I mean, come on, you know all of this. Ditto doesn't spam you. No one will try to upsell or cross sell you something you don't need. There's claim assistance as well. It's free and very important, especially in the case of health. And everything starts with a 30-minute consultation, which is again absolutely free. So, what are you waiting for? Book your slot today, and as always, the link is available in this video's description. Alright, now that step one, the planning part is done, let's examine each of the variables we've used and explore how best to manage them. We start with income, and if you're looking to accelerate your retirement goal, then start finding ways of increasing it. Some of the possibilities include asking for a raise at work, taking up a higher paying job, improving your skills. You can go abroad, build up a second income, start a business, do whatever. But the fact is, the more you earn, the more you can save. And logically, dekha jaye to retirement is anyway all about savings. The sooner you get there, the better it is. And even if you want to take the slow path to retirement, that's still not an excuse to settle for less income, especially if you're someone who's struggling to reach the retirement number that we calculated in step one. Okay, the second variable is expenses, and there are largely three parts to it. Firstly, there are large expenses, so things like housing, car EMI, etc. And while you can choose between buying or renting, in many cases there isn't much that can be done here. Then there are the smaller and generally invisible expenses: Starbucks, eating out, your OTT subscriptions, etc. And if you don't control these, this can add up to quite a bit over time. I honestly think some of these expenses are a bit excessive, which might not be necessary as one might think. And if one can rationalize these, it can easily add 1,000 or more in your savings every month. And finally, there's debt, and again, a lot can be done here. You can completely cut out your credit card expenses, just cut the card in half, do a balance transfer if you find a better deal on your car or your home loan, do pay your outstandings on time so that the credit score goes up. And once it does go up, reach out to your bank loan and renegotiate your loan interest rate. I'm sure we all understand not every expense can be reduced, but if one works smartly at it, I think everyone can save at least 5% of their monthly expenses, which is like getting an extra 5% return on your investments. Speaking of which, the third and an equally important variable in our retirement calculations is investing, or rather investment returns. In our example, I had assumed 10% as post-tax returns, so that's 3% over inflation, which I think is a fair projection over the long term. Of course, you can make a lot more than 3%. My own long-term expectations are like 6% over inflation, and I honestly don't think one has to do something really adventurous or risky to get there. Just take care of your asset allocation framework like the 3x3 grid I explained in an earlier video. Invest systematically, be disciplined about it. Again, I have relevant videos on my channel. Adopt good risk management policies. Learn to absorb the volatility that every equity market has had and will have in the future. And if you're tracking your portfolio regularly, then I believe that's all one needs to achieve a respectable return on one's investments. Right, so I've gone through a couple of steps. Step one was on determining your financial freedom number, the amount you need to have at the time of retirement. And then step two was on building a better understanding of which variables you can play around with so that it improves your chances of quickly reaching that retirement number. So these two put together is what we can typically call as a retirement blueprint, which brings us to the third and final step, that is executing the plan. This is easier said than done, and believe me, there will be lots of distractions and deviations along the way. Some of these would be in your control, like taking a career break, buying a second car for the family, changing cities, pursuing higher education, etc., while others won't be, like a job loss, a medical emergency, recession, an unexpected legal issue, business loss, natural disasters, etc. All this will require you to make adjustments to your plan, which can range from something like reducing your monthly expense outgo, focusing aggressively on increasing income, renting rather than buying, relocating to a low cost city, extending the retirement age by a few more years, etc. One has to be flexible here, and the truth is, even the most carefully designed financial plans will rarely unfold exactly as you planned it. That said, a couple of things that have helped me over the years include A, developing an obsession with ROI, and secondly, measuring one's progress. So, ROI means ensuring that whatever you put big money into generates for you the sort of returns that you can truly appreciate. It's a different way of looking at things. But for example, if you're buying an iPhone for no visible reason beyond making calls or showing it to your friends, then it's probably not offering you any appreciable ROI. However, if you're using this same iPhone to make money, to make Instagram reels earning 2, 3, 4 lakh rupees as some of the influencers do, then buying that iPhone is surely worth it. I know it's a crude example, it may not work for everyone, but such things surely work for me, helping me save lakhs of rupees over the years, and no, I do not own an iPhone yet. My second advice is on measuring progress, and this can be as simple as setting half yearly or yearly financial targets. I definitely do this for my investments, and the place where most people get it wrong is in their understanding of this formula. So, for many of us, investments are what remains after expenses have been deducted from our incomes. But if you want to get this right and to your advantage, then explore switching the expenses and investment part, in the sense that once you have allocated money to your investments, it's only then that the balance can be used for expenses. Of course, it's not enough to just learn this formula, it's important to execute it as well. So, do use this weekend to make changes in your finances such that your income, expenses, savings, and the ROI of expenses are all optimized. Retirement. On second thought, maybe retirement isn't the right word for this video, and perhaps a more accurate way of describing today's presentation is financial freedom. I say it in the sense that although some of you might have enough to retire in your 50s, 40s, maybe even in your 30s, but not everyone wants to force themselves out of work. I won't even suggest that, as without a drive, without a goal, the mind can start rotting. Instead, the achievement of financial freedom helps us to semi-retire, in the sense that I can now make shifts aligned to my personal interests. So I can work on what I like, I define my own hours, I can take short breaks of a month or two for travel, help a friend out on a project, etc. And I'm sure many of you watching this video will like that for themselves. Of course, there's a time for everything, and I hope this video has given you some clarity on how you should go about that process of retiring early, or rather achieving financial freedom fast. And while you do that, don't forget the basics, like opting for a good health insurance plan for your family. If you're keen, let's start you out with a free of cost 30-minute consultation with a health insurance expert at Ditto. Just use the link in this video's description. Once again, thank you for your time. If you like this presentation, do give it a like, share it with your friends, especially the ones in their 20s and 30s. Subscribe to my newsletter, and I'll see you very soon. Until then.